Hi guys, welcome back to the Financial Interest YouTube channel. My name's Dan. So in this video I wanted to cover Phil Town's Rule 1 margin of safety calculation. And this is what Phil uses to calculate the intrinsic value of the company, or he calls it the sticker price. So let's get on with the video. So for any of you who are familiar to the channel already, one of my key people I follow is Phil Town, and you'll know that I did his Rule 1 investing workshop a couple of years ago in Atlanta when they were still able to do the event in person. I believe now they're all doing it online. So Phil has this calculator on his website, so you can actually go to that. I will leave a link to this and you'll also see it as I go through the process on the screen as well. And you'll also be able to find it in his books. So you'll see probably over there. So some of the books behind me are his books. So you've got the Rule 1 followed by Payback Time, and also the Invested book, which is the most recent one, which he did with his daughter Danielle. I think that was 2 or 3 years ago. And these are all really good books for kind of understanding the basics of value investing. So I'd highly recommend reading those as well, because they're really helpful. So Phil uses 3 different valuation methods for establishing the intrinsic, or the sticker price as he calls it, and they're all based on different metrics. So first there is the 10 cap price, and this is based on the owner earnings, and then we have the payback time, which is based around the free cash flow, and finally the margin of safety, which is based around the earnings, and that's the one which I'm actually going to cover in today's video. And throughout the video, I'm going to use the example of Texas Roadhouse. So in order to make the calculation, we need to use 4 different numbers. So first we need to look at the earnings per share, or the EPS. And then we need to establish a future growth rate. And then after that, we need to estimate the future PE ratio. And then we outline our minimum acceptable rate of return, which is actually 15%. We keep this the same for everything. So let's look at the EPS here. So what we're actually trying to do is look at the earnings per share for the previous 12 months, or TTM, trailing 12 months. Now it's important when we're looking at this that this number is actually similar to what it's been in the past, because if there's any outlier years which shows that the earnings per share is a lot higher or a lot lower, then we need to look at using a different number. Okay, so the first thing we're looking for is the earnings per share for the previous 12 months, so that's TTM. We can see here that based off the most recent report, the earnings per share is 45 cents. So that's actually quite a decrease from the previous report from 2019. So that's why I'm not really going to use this as an example. So this looks like an outlier year really, because last year the restaurant industry was hit quite hard. Obviously with the restaurants being shut and limited capacity and things like that. So what I actually want to do is look back to the previous earnings per share from 2019 and 2018 to try and get a better idea of what a normal kind of level would be for that. So we can see here we've got the earnings per share, and now this column here is showing the results from 2019, then 2018 and 2017. So we've gone from 2017 184 to 220 to 246. So for this, I'm going to use the 246 because I think it's more realistic amount to use. The way I look at this is that the actual earnings per share from 2020 is actually an outlier, and I think that it's more realistic if we use the number from 2019, because I was just listening to the earnings call, because Texas Roadhouse has just released their latest financial statement. And actually what they're seeing for the start of 2021 is only a 2% drop in sales for the first 7 weeks of the year. So based on that, it looks like they're in a good position to actually return to pre-2020 kind of numbers. So for the purposes of that, I'm going to actually use the old number of $2.46, because I think that's a more realistic starting point for this. So now we'll go to Philtown's Real One website, and you can go here to resources, investing calculators. So if we just look down, we can find it here, and we're looking for the margin of safety. So sticker price and margin of safety, calculate sticker price. So this is a calculator where we input the data we've got. So we've looked at this, and the current earnings per share we want to go with for this is 246. So that's the first number that we input. And after we've got the earnings per share, the next bit is kind of where the more of the research is involved. So we've got to come up with a future growth rate. And this growth rate is going to be a compound growth rate for the next 10 years. And this is where we need to have looked into the moat, the management, and also the previous numbers as well. And it's important to remember that past growth doesn't necessarily represent what the company will grow at in the future. So I also have subscription to Philtown's Toolbox, and here we can see the key numbers that he bases the growth rate off. So here we've got the book value per share plus dividend growth, earnings per share, operating cash per share, and the sales growth. So here you'd be given the 10 years, 7 years, 5 years, 3 years, and the last year. And what we're looking to do here is come up with basically an average. So we look at the 10-year figures, we've got 12.4, 13.9 on the earnings per share, operating cash flow 12.5, and sales 11.3. And this is over the past 10 years. So we can see that these are all, we can see here nothing is below 11.3 on all of them across the different time ranges as well. So because that's the previous 10 years, and obviously as a company gets bigger, it's more difficult to maintain that going forward. So for a 10-year growth rate, I'm just going to use 10% going forward. And obviously this in reality will be a lot based on the research you've done into the management, the moat, and the previous numbers as well. But I'm just kind of giving you a rough idea about how I go about it. And now moving on, we go to the future PE ratio. So as a rule of thumb, we want to double our growth rate to get the PE in the future. So based on what I've estimated there, I'm saying a growth rate of 10%. So I simply double this to 20 for the future PE. We need to make sure that by doubling the growth rate, we don't exceed the highest PE that the company's ever seen in the last 10 years. So 20 is quite safe here because I can see that actually the high PEs recently have gone up above 100, and that's purely because the earnings has dropped by around 80% year on year. So that's like they just reported the earnings and they've seen an 80% drop since the 2019 reports. But actually the share price in that time has been continuing to rise. So that's why you get the kind of large change in the PE ratio. So we look on Yahoo Finance here, and let's look at the growth estimates for Texas Roadhouse. So the next 5 years per annum, so we're looking at an 11.07%. So that makes me feel a little bit better about my 10%. Obviously the analysts here are only estimating for the next 5 years, and I'm estimating for the next 10 years. And you can see the previous 5 years, they've done a 15.17 growth. So I'm kind of happy enough with my 10% growth amount for Texas Roadhouse. And for the minimum acceptable rate of return, or referred to as MAR here, we use 15% because that's a kind of good amount, so we can get a better return than the average of the market. Obviously, if we're going to put a lot of time into researching individual companies, we want to get more than the kind of market average of whatever that is. I think it may be around 8 or 9%. So we want to be getting a lot higher return than that to justify it. But at the same time, if we go too high with our minimum acceptable rate of return, it means that the price we need to buy it for now is going to be lowered. So that means it's going to make it more difficult to find businesses that are actually ever going to get to that on sale price. So we see here, we have our earnings per share, the 246, 10% growth rate, 20 PE, 15% minimum acceptable rate of return over a 10-year period. And finally, when we've established the final number, what we do is then divide that by 2 to get our margin of safety. So by dividing by 2, obviously that's giving us our 50% margin of safety, and that's the number that we actually need to buy the company for now. I want to show you how it is here. So I've just made my own spreadsheet just to demonstrate this as well, because I like to actually see how they come to the numbers. So here we've got different growth rates. So the 10% growth rate here at 246, after 10 years we're going to be at $6.38. Future PE is 20, and that gives us our future value of 128. And now we take the 128, and what we're basically doing here is we're just dividing it back by the 15%. So this is our minimum acceptable rate of return. And then you'll see, like, as we go down each year, then we come all the way back down to, as we have in the calculator, 31.54, or as you'll see, it's rounded up to 32. And then we have our margin of safety of $15.77, which is rounded up to $16, which is what you will see in the amount on Philtown's sheet. And there we have the amount of 16. So we can see on Yahoo Finance now, the stock is currently trading at 87.91. So that's well above our margin of safety price. So our margin of safety price is actually $16, which is very low, and our actual sticker price or intrinsic value is $32. So we have to go back to March, where the first kind of crash happened. We can see that this was on the 18th of March. The price hit a low of $30.41. And that's the lowest it's been for like a very long time. So you can go out here to see the 5-year, see where we are now up here. We kind of hit the low down here, but the rest of the time it tends to trade above the quite a lot above the intrinsic value. So the only potential opportunity would have been in March, but actually that's only to have got it at the about the intrinsic value or sticker price. So actually that wasn't close enough to we want. But it's a good example to look at as well. So that's it for the video. I hope you enjoyed it and found it useful. If you did, please leave a comment on any different valuation methods you use. I know it's like there's a lot of different ways out there. This one is kind of loosely based on a discounted cash flow analysis, and I know that's kind of most popular ones through people like Warren Buffett, and that's another method I use as well. But I just wanted to throw this one out there because it's quite simple, and obviously they've got the calculator on the website. It's a kind of good basic starting point to put a value on a company. So if you enjoyed the video, please give us a like, and also consider subscribing to the channel for more content like this. So thanks for watching, and I'll see you in the next video. Cheers.